You're listening to the Cash Flow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cash Flow Academy podcast, where investing is made simple. I'm your host, Andy Tanner. We welcome you and congratulate you for tuning in. As always, we've got a great show on deck with a great guest. Tom Lydon is with us, and we're going to speak a little bit about ETFs, gold, the market in general, and a little bit of background on Tom. He started out his experience at Fidelity many years ago in asset management, and he's a major contributor to print, radio, TV, Wall Street Journal, Forbes, Investors Business Daily, Barron's, Market Watch. If you follow those, you're familiar with his work. And his website is etftrends.com and also etfdatabase.com, where he provides content for investors to make great decisions, gives the information to make informed decisions. And so with that, Tom, thanks for being on the podcast today.
Well, it's a pleasure, Andy. Great to be here. Thanks for inviting me.
This should be a lot of fun. Tom, tell us a little bit, I gave a little background, but tell us a little bit about why you decide to do what it is that you do.
Yeah, well, Fidelity was many years ago. I grew up in the Boston area, went to Babson College, spent a few years at Fidelity, ended up coming out to the West Coast, ended up working with a client in the advisory business and started my own advisor in the mid-90s. At the time, we were using 100% mutual funds. And then as time went on, we had some trend following strategies that worked well, but the mutual funds that we used, the companies weren't excited when we sold. They were happy when we bought, but they weren't excited when we sold. And at the time, there was this new thing out there called a ETF, an exchange traded fund, in the early stages. And the great thing about it is you could trade intraday, and you didn't have to report to anybody when you were buying and selling because they were meant to be traded. So we gradually transitioned in the early 2000s, most of our business to ETFs. And in 2005, I started a little blog just for educational purposes, ETF Trends, to talk about the new trends we were seeing in the marketplace. The ETFs are representative of those trends and some investment strategies. And you know, the more we wrote, the more people showed up, and one day we woke up in the publishing business, which was a little crazy. So now we do a little everything, and there's still tons to help advisors and investors on regarding education in the ETF world.
So ETFs are an interesting product, as you say. They come on the scene and caught on like wildfire, and it's really an interesting idea in terms of, like, if you were an investor in real estate, you look at an individual property and you see earnings coming in and, you know, net operating income and cap rate, and you really take a look at that business. Stocks have kind of evolved away from that Warren Buffett. Not everyone is a Warren Buffett, and so, you know, they say, well, let's buy everything and diversify, and winners outnumber losers, hopefully, which really is a detachment in my mind from fundamental analysis. But ETFs, you know, particularly the one I wanted to talk about the most today, if we could, is the gold ETF in GLD and other precious metal ETFs, and get your take, and if you could give us a little education on those. And I don't want to be long-winded because I'd rather have you talk than me, so I'll try to set this up. The reason for this question is back in 2007 and 8 in the subprime meltdown, the Federal Reserve had unprecedented stimulus, and over a period of a couple of years, we'd do $50 billion, and we'd buy. They went from buying just government treasuries into, you know, some CDOs, and they bailed out some banks and took on some pretty toxic assets. And a lot of people said, well, my gosh, you know, this amount of printing and this amount of, you know, quantitative easing, low interest rates, is just going to kill the currency. And so people poured money into silver and gold and precious metals. SLV ETF hits $48 a share, which is closely correlated to an ounce. And during that time, I run with a lot of gold bugs. My grandpa was a gold bug. You know, I like gold. But a lot of people say, well, you know, ETFs don't really give you exposure to precious metals because they're paper, and because, you know, it's not you can't get it payable on demand like a silver certificate. It's not real. So I'd like you to speak a little bit about, I have both. I've used the ETFs in terms of getting exposure to precious metals, and I also own the physical stuff. I own them for different reasons, but before I share my reasons, let's go to the expert. Let's hear what you have to say about gold ETFs.
Yeah, Andy, so great stuff. As you know, real assets, gold, silver, have been a staple in investors' portfolios for decades, centuries, right? And they deserve to be. It's a stable value during times of volatility, provides diversification, and especially during times of uncertainty, they perform pretty well. And you point out what happened after the financial crisis. Yeah, gold continued to do well. Specifically to the ETFs, it comes in a variety of forms when we talk about metals. Traditionally, in the mutual fund arena, the way to invest in gold was through mining companies. Yeah. And those have been around for decades and do well. Some are managed different than others, but there have been billions of dollars that have flowed into mining-based mutual funds over time. And those also are around today in the form of ETFs. Same thing. Some are indexed, some are actively managed. But if you look at some of the biggest ones, for example, GDX, which has $15 billion in assets offered up by Van Eck, there are some of the biggest miners in there. And rather than buying the individual mining company, like a mutual fund, you could buy the ETF. It provides some added benefits in the form of additional liquidity, so you could actually buy it in the morning and sell it in the afternoon as opposed to a mutual fund. And also their tax advantages as far as the underlying creation redemption provides the ability for the manager who might be buying and selling some of the underlying not to have to pass it on to the end investor. I think we've all experienced mutual funds over time, and especially periods of time when there are net redemptions in funds and the market might be flat. You know, at the end of the year, around the holidays, to get this holiday bonus and the fact of a 10 or 20% redemption isn't that much fun. ETFs really avoid that to a great degree, as many people know. So from a taxable standpoint, ETFs are a great choice for your taxable accounts. Okay, so getting to gold. State Street worked in conjunction with the World Gold Council, which is basically an organization put together by all those mining companies. And they put the World Gold, the State Street Gold Trust together, where World Gold Council has a hand in that, and the miners actually have a hand in that. It was an opportunity to provide liquidity to real gold. And that's the point, and I think this is what you're getting to.
Yeah.
People feel like this might be a smoke and mirror game, and the fact that you're not really buying gold, but it's really some type of paper that represents gold. So I'm happy to tell you, after knowing the organization, both World Gold Council and State Street, for a long period of time, that there is a system to this, and it's real specific, and it's specifically tied to assets. So State Street has a vault in London. We don't know where it is, but on a daily basis, there's an accounting that's done to make sure that the total amount of gold represented in GLD and some of their other gold-backed ETFs specifically tied down to the ounce of gold that is in their vault. Okay, and we know for a fact that this occurs. There's a lot of checks and balances in place. But on top of that, my friend Bob Pisani at CNBC back in 2012.
They blindfolded him, didn't they? They blindfolded him.
They blindfolded him. They put him in a van with curtains, and they shuffled him through the streets of London and blindfolded him, got him inside where he could actually see the gold itself, brought it in with cameras. He said it was really hot and sweaty. I asked him, I said, did you get any gold on your suit? You know, but it's not smoke and mirrors. There's a lot at stake here as far as the trust behind this and the importance of making sure that there's a high level of confidence. So the gold exists. If you want to buy the price of gold in your portfolio, you actually can do it through GLD, and it is spot on forgive the pun, to the price, and it tracks very, very, very closely. And as you know, there's some great advantages to that, as you being a buyer of the ETF and also being a buyer of the physical gold. Buying physical gold is great because you can touch it and sniff it and you can pass it on. However, there's commissions to be paid when you're buying and selling it. There's also storage costs, which you may or may not want to tackle. But if you just want to buy gold and have diversification in the portfolio very, very inexpensively, you can do it in the form of GLD and a whole variety of other ETFs that are tied to gold, silver. There are even some ETFs that represent platinum and palladium. There's a ETF by Aberdeen called Glitter, GLTR, where it's a cross-section of gold, silver, platinum, and palladium. So you can get all those into one ETF.
Yeah, I'm going to give your website out again, etftrends.com, and also ETF database, because there's no substitute for education. You know, we live in a culture of advice where people watch CNBC trying to get a tidbit and they don't put in the work to understand investments. And as an education advocate, I think resources like you have, Tom, are just invaluable. I'd like to say this, and you can comment on, I'll give you my thoughts on gold, is I have physical gold. And, the problems with physical gold for me is, number one, you got to store it. And it was really funny. I had a great friend of mine who has, he's a gold bug and he's a gold dealer, and he'll store it for you in his vault. And we were on a cruise, and we were both speakers on the cruise, and we were at dinner with some of the attendees, and I was the only guy that really was talking about paper assets like ETFs and stocks. Everyone else was a real estate guy or a gold guy, physical stuff. And I said, so if I buy $1 million of gold, I really want to keep $1 million of gold in my house. And he goes, oh, no, I'll store it for you in my vault. And I says, well, how do I know it's mine? He says, well, I'll give you a receipt, and it shows that it's yours. I go, what do you print that on? And he knew that he'd been had, at the dinner table. And so, there's conspiracy all the time, that Bob went in and there's a story that says, oh, but we looked at the serial number on one of those bars of gold and it's not listed, blah, 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 blah. But people need to understand that when I buy physical gold, I'm not doing it to make money. It's an insurance policy. In other words, when I buy it, I don't buy it thinking I'm going to get rich in any way. My hope is, with my physical gold, that my kids get it, my grandkids get it, my great-grandkids get their share, and hopefully they add to it. If I end up, selling my gold, it's probably because the world got in trouble and it was really important to liquidate it. I like the ETF for I don't need to store it, so that storage problem goes away. The markups on that when you buy that stuff, those spreads are really wide to buy and sell physical gold. But what I really love is that many of these are optionable, and I can write puts to get paid to buy my exposure to gold. In other words, I can write a put option, and I can get paid to buy my precious metal exposure. So I use it for different reasons, and I think they're entirely different investments. But for some reason, people, it just drives me nuts when they say, well, ETF gold is not real gold. Well, yeah, it's not physical gold that you hold in your hand, but the exposure to gold has been legitimate. And as you mentioned, not all ETFs track well to the underlying asset or industry. This stuff has tracked well for years. So maybe you could speak a little about this. I did a podcast on the USO, and the USO is based on futures. And so the problem with futures is there's a lot of people that want to speculate on price that don't actually want to take delivery of the oil. And pretty soon you have the Saudis and the Russians fighting, and then you have COVID hit where the price of oil gets, literally went negative because no one wanted to take delivery. All the barges are full. If you got a place to put it, great, you can get a great deal on it. Could you speak about the difference between a commodity like gold and how that ETF works, and a commodity like oil and how that ETF works?
Yeah, and it's really important. And unfortunately, gold kind of gets a bad rap because of what happened with USO. But to USO,
hence our conversation, right? Hence our conversation, right? It's getting a bad rap because USO kind of was a mess.
But in reality, in USO's defense, it did exactly what it was supposed to do. The price effectiveness of those 1 month future contracts, forward future contracts, were in fact really crushed based on what was going on in the world and the fact that we just had a glut of oil out there and nobody wanted it. So that's why it went negative. I mean, this is one of those things where you really have to look under the hood and you have to understand what you're buying. And it really, the main difference is this: with GLD, it is tied to the physical gold, and the gold is in the vault, and there's an accounting for it every day. There's not futures on gold. It's backed by physical gold, where in USO, you actually are buying futures. I mean, it's really tough to take inventory, or for an ETF to take physical inventory of gold, and of oil, and we don't feel that's probably ever going to be the case. But through what happened with USO, we definitely saw that there was a chink in the armor. And because it was the front month contract, it was what was going on at this minute in time, when in fact people were trying to buy in because things were so low on oil that they saw, hey, here's an opportunity to kind of buy low because I feel in the next 6 to 12 months oil's going to bounce back. But guess what? You weren't buying the next 6 to 12 months. You're buying the next month. And nobody wanted your oil in the next month. So that's the disparity between physical gold and having it in a vault and paying for deliverable oil that's going to happen in the next 30 days. It's night and day, right?
Yeah, it's huge. And this leads into two other things in our remaining time that I think it'd be valuable to speak about. First of all, we'll talk about new investors, and then we'll talk a little bit about the fundamentals that we see. Robinhood, the little online app on your phone, it kind of targets the Generation Xers. They had 3 million new users come on in the first quarter. E-Trade set records, Ameritrade set records, Schwab. I think Ameritrade, TD Ameritrade had 600,000 new accounts in the first quarter. Unprecedented growth. That's 154% over what they had in the first quarter last year. Incredible new accounts. And a lot of that last year was because they went to zero commissions. But what I think has happened, and this happened with the USO, is I can't tell you the amount of friends I had or acquaintances I had that saw the USO go close to zero and thought, well, oil's never going to be free. I'll just buy. I'll just get in and buy. And here are people who have never invested before, that have zero education on this, and the greed of missing, greed's the fear of missing out on the big score. All these people are flooding the market saying, well, look, COVID, market's down. It's on sale. Buying opportunity. And some of them were right. I bought a lot of stuff in the dip, thinking it'd be a V more than a U recovery. But can you speak to your opinion about the role education plays? ETFs are good and they're bad. They're very easy to get into. And, I would always take my son to a hunter safety course before I give him the power of a rifle. Can you speak to the importance of education? Or ETFs just let's go out and I'm an investor today. Let's go be an investor.
Yeah, and especially today, we're in the situation where we've got kind of the perfect storm for this generation, right? So it's tough for them to work. Many of them have been disrupted that way. They're having to spend a lot of time at home, like we all are. They're not, there's no sports out there. You can game only so much during the day, but many are turning to the stock market as an opportunity to maybe not only be educated about the opportunities to make money, and maybe they can make money themselves, but it's entertaining in nature, and Robinhood's a great example.
The casinos are closed. I mean, you can't,
Right.
There's no horse betting going on, so why not, right?
Well, there's always DraftKings if you live in the right state. So there's always something to bet on there, but it's all kind of thrown into the same pot. So were younger investors, as I'm looking at a chart right now of Robinhood holders of USO versus the underlying price, and it's amazing to kind of see what happened, because there were virtually no shareholders at the end of February, and all of a sudden in a matter of 4 weeks, there were 220,000 Robinhood accounts that owned USO.
Incredible.
Right? It's just crazy.
That's an ignorance chart, right? That's a chart of ignorance, in my opinion. That's like a metric of people who are not very smart.
Well, we all learned from experience, and hopefully, because the average account size at Robinhood's about $2,500.
Yeah, it's small.
It was a inexpensive lesson that you learn at a young age, and you're probably not going to make that same mistake again. I know you and I have probably made a lot of mistakes over time, and we learn from them. It's a lot better to learn those mistakes with less money and at an early age, so you don't do it when it's later in life. But because there were a lot of people who put a lot of money into USO and were hurt bad. Yeah. We have currently going on so far this year, in the last year or so, a lot of people playing the VIX and the VIX contracts and their VIX-related ETFs. Yeah. And there have been some prizes that have come up recently. And Credit Suisse is just decided, you know what, they're going to get out of that game. They've got $1 billion ETF, TVIX, that they just said, we're closing it down. So there's good and the bad that comes with that. I mean, the ETF has been around for almost 27 years. For the most part, it's pretty much plain vanilla. You know exactly what you're getting. But there are also some creative issuers that have provided some good opportunities in some esoteric areas. But as you point out, you have to be educated. You have to look under the hood. You have to understand both the upside and the downside. And it's tough out there. Wall Street is not easy. It's not easy, as you know, to make money quickly. And there's a lot of speculation that's going on right now. Some people are doing okay by it, and some people are getting burnt.
Things like the USO trade in contango, usually. We can have super contango, and there are ETFs like you mentioned that track the VIX. They'll eventually go to zero. I mean, they will eventually go to zero because of how they're structured, and they're really built for short-term insurance, I believe, against a short-term prediction to protect yourself. There's certain ETFs that are not meant for investments, but they're meant as hedges. In my opinion, that they'd be best used for that. So again, ETFtrends.com, you want to learn about this stuff, listen to Tom and what he has to say about it. Final thing we'll talk about is what I feel is a detachment from fundamentals, and I'll get your take on this in the big picture. Again, I go back to Warren Buffett. He holds about a fifth of his money on the stock side of his business. He owns a lot of stuff outright, like Geico and Fruit of the Loom. But on the stock side, he's got a ton of money in Apple. Almost one out of every $5 he claims to own is in Apple. And if you take his top 7 holdings, that makes up about 3/4 of his stock portfolio. He's got 500,000 shares of Verizon at the bottom, small amount for him. And here's a guy that really cares about earnings and growth, Benjamin Graham, an intelligent investor. So then you have the other people say, well, look, not everyone can be a Warren Buffett, not everyone's going to study, so we give a mutual fund and we buy everything and hope winners outnumber losers without maybe doing as much fundamental stuff. And then we get like Jack Bogle type stuff like Vanguard 500 and SPX or SPY, where look, you're buying the S&P 500. Now think about this for a moment. You have Ted Benna, who gets the 401k going in the 80s, and now we have $4 trillion or $7 trillion in 401ks, and people are on schedule to buy things. They get a paycheck, and that's how we think our retirement's going to be. And then Janet Yellen comes out and says, we should let the Fed buy equities as well. I mean, money's going into equities anyway via the Fed. The rich are getting richer. And this is what bothers me. The more we use stimulus to buy things to prop up price, isn't that a detachment from fundamental investing? And doesn't that create a problem where if we're just buying everything to buy it, right? 500 companies, you got some lemons in there. What do you see? Do you see a detachment from fundamentals? Everything I see fundamental-wise, this market should be in the tank, and yet the Fed stimulus has been thus far pretty much effective in propping up the market. It certainly isn't fundamentals propping it up. Or do you feel that Wall Street says, look, this is going to pass, No need to panic. We're finally going to do what we've never done before, is hold through tough times. What's your take?
Yeah, Andy.
Long question. Sorry about that.
No, it's good, and you framed it well. And Andy, I think you're right. Dave Nottig, our director of research that we just got on board this year, that just came over from heading up ETF.com. We talk about this all the time. It's just a head scratcher. When you look at what's going on as far as the fundamentals regarding unemployment, the decline in earnings projections, and a lot of companies are just going quiet and not even saying how bad it's going to look.
Yeah.
It's a little bit crazy. However, I just listened to a podcast this weekend with Jeremy Siegel, and he said this time it's different in what the Fed and the U.S. government's doing as far as this backstop. They're getting the money to the people. In the past, what they did is they gave it to the banks, and it took a while to get to the right places.
Right.
This time around, it's going directly to M1 and M2. It's getting in people's hands, which did a great job in stopping the bleeding. That's the question, right? How quickly and how long can you stop the bleeding? Because the pain from unemployment, from decreased earnings, from decreased productivity might continue on for an extended period of time, and everyone's looking at the same numbers. We're all looking at COVID numbers. We're seeing this recent spike. We're seeing things that are supposed to be opened up that may not be opened up now. And everyone's got their fingers crossed of when we might get a vaccine, because outside of that, if we're still having to battle this, it's going to affect our economy and the world economy in a variety of different ways. Now, that being said, there's some industries and there's some specific companies, like you said, with Apple, which are made for this environment, right?
For sure.
And you look at FANG stocks. It's amazing. We've been talking about FANG stocks for years and how well they're positioned. Well, they're also positioned great for a COVID environment.
They are.
It's all about technology. It's all about buying online. It's all about communication. It's all about entertainment. This is what FANG stocks are all about. And when you throw Microsoft in the mix, that group represents 47% of the NASDAQ 100. It's
no wonder it's at new highs, right?
right. So we're going to be probably in a situation where the stock market will continue to be bifurcated, and we'll scratch our heads. But those types of companies not only are thriving in this environment as we're more focused to doing things online, and we'll come out the other end of this when we're past COVID, better prepared to act online. I mean, you think about online buying last year, people don't understand how small it was to total retail buying, only 14%. They're saying that maybe this year it might hit 23%. Still a long way to go, right?
You look at that idea, and a lot of the people who are physically suffering are the older people in rest homes who probably, they might have been 3 weeks away anyway in hospice. Mm-hmm. And that's kind of where Neiman Marcus might have been even without COVID, right? With Amazon. And I mean, there's a lot of dead wood that's being burned by the forest fire because it's dead wood. And there'll be a lot of that. However, I'll tell you mentioned M1, M2 money supply. The chart that, you go to Fred, the St. Louis Fred, and bring up all those charts. The one that takes my breath away is velocity. If you bring up a chart on velocity of money, it's the lowest I've ever seen it on any chart anywhere. And as that money, you're right, it skips through over the banks now and it's going right into people. I think this money's done. And if we don't get another trillion in July, and you hit it on the head, how long can you keep subsidizing? And I think the unemployment numbers are not real because the PPP program is an unemployment program. It's just instead of coming through the government, it's going to the government, to the employer, to the employee. There's a lot of employers that have people not working that are getting paid through PPP money because that's part of the deal, right? Don't lay guys off. So it is going to be an interesting thing. Companies don't have guidance. So many people pulled guidance. It's a time to learn. And if you want to learn to hedge, ETFs can be a great way to do that. And options on ETFs can be a great way to protect yourself and hedge if you care about that type of thing through the coming months as this stuff unfolds. I certainly don't know where it's going to go. I'm not smart enough to have a crystal ball, but I am smart enough to buy insurance just in case. And if I lose that money in insurance, I say, well, my house didn't burn down. At least I had some peace of mind. Didn't make what I wanted, but I like to have a little hedge out there. Final thoughts for anyone listening, particularly those who are newer, the Robin Hood type guy, I'm going to be an investor all of a sudden. Any advice for those guys or last words for them?
Yeah, well, first of all, thanks for having me on. GLD or any gold-backed ETF right now makes a lot of sense for a lot of fundamental reasons. We could spend time on that, but from a diversification standpoint, it does make a heck of a lot of sense. The other thing is the S&P 500 in the last 10 or 11 years has been really tough to beat, and so something like SPY is done very, very well, but we're probably going to see more technology and disruptive technology companies step up. If you're interested in more of those types of ETFs, one company that does a great job representing that space is ARK Invest. Kathy Wood, really great numbers that they put up, and they have a whole variety of ETFs in the disruptive technology space. The cool thing is they share their research, so if you want to find out more about the underlying companies, you can dive in there for people who are looking for education, because probably within those types of companies, we're going to see the next FANG stocks emerge in the coming years, and that's really what people should be concentrating on. Where are we going to be in areas like biotechnology, genome sequencing, autonomous vehicles, stuff like that. AI, 5G. So these are the technologies that are going to be booming in the next 5 years, and you probably don't have them in your S&P 500 ETF or mutual fund.
Very smart. I couldn't agree more with the genetics, biotech, and AI in communications. Those are just going to get better and better. Anything that has to do with data. And China is going to kick our butt with AI. They don't have the privacy concerns we do. Well, they probably do. They just don't care. And the amount of data they can collect, and they got it down to how often a guy charges his cell phone down there, right? They got data on people, and that just feeds the AI machine. They got 1 billion people down there with no rights to privacy. They're gonna beat us to AI. So I think you watch China as well. Tom, I can't thank you enough. I've wanted so long to have someone on the podcast that could really, with some authority, some credibility, to say, hey, get educated about your ETFs and understand that not all of them operate the same, and that if you buy a gold ETF, you got some exposure to gold, and you're not buying a fraudulent piece of paper, what have you. So I thank you so much for being with us. Thank you.
Thank you, Andy. Appreciate it.
You've been listening to Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where investing is made simple. Again, you can check out Tom Lydon at etftrends.com and also etfdatabase.com. We'll see you next time.
You've been listening to the Cash Flow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.